In 3 to 4 years, Tesla will likely be producing 1 million cars per quarter, not just 310,000. Looking ahead 10 years, that number could grow to 5 million cars per quarter. Right now, Tesla is making 310,000 cars per quarter, and people are debating small fluctuations, but I'm looking at the bigger picture. This is a 20 million car company in the making. If you recall, when I initially spoke about this investment, I predicted we would make 20 times our money. We invested $380 million in Tesla between 2014 and 2016 at an average price of around $40 per share. So far, we've made roughly 20 times our investment, bringing in about $6 billion. We sold around $1 billion worth of stock. Yeah, I still believe this is only the beginning. Tesla recently reported 310,000 cars produced in a single quarter. Over the next 10 years, I believe investors will make 3, 4, or even 5 times their money on Tesla. Eventually, all cars will be electric, and hybrid vehicles are merely a temporary solution for traditional automakers to avoid losses while they transition. In the long run, hybrids will be phased out because they're costly and inefficient. The stock's recent dip isn't due to quarterly numbers. It's about perception. People get stuck in old ways of doing things, resistant to innovation. The quote, "Show me the incentives and I'll show you the outcome," rings true here. People act based on incentives, and right now, the market isn't fully appreciating Tesla's long-term vision. Tesla is moving into robotaxis and producing a low-cost car. They currently have the capacity to manufacture 3 million cars annually, but are producing 1.8 million. Meaning they have 1.2 million in unused capacity. While the cost of manufacturing this new vehicle will be higher than initially expected, Tesla plans to produce 5 million units of this model. One of Tesla's biggest advantages is data. Out of the 6 million cars they've sold, 3.5 to 4 million are actively collecting real-world data. That data is invaluable, and Tesla is now doubling its computing power. For years, progress stalled because computational resources were insufficient. With version 12 of its full self-driving (FSD) software, Tesla is leveraging massive amounts of data and advanced compute to improve autonomous driving. Humans can't process that much information, but Tesla's AI can. During a recent test drive, I saw the power of Tesla's autonomous capabilities firsthand. I entered an address, Steve Jobs' house, and the car drove itself there. It navigated through a parking lot, waited for an opening in traffic, and merged onto the road without human intervention. This is the future. Initially, the idea was to sell cars and then monetize autonomous driving separately. But now Tesla is also negotiating deals to license its FSD software to other automakers. Tesla currently makes about $7,000 in profit per car on a $35,000 vehicle, not including the $7,500 federal tax credit. Traditional automakers struggle with quality control. General Motors factories achieve 97% defect-free production, but Tesla is still ramping up to that level. Over time, Tesla will refine its processes and further lower costs. The key factor will be reducing battery prices below the cost of a traditional internal combustion engine, IC. When we first invested in Tesla, battery costs were $35,000 per car. Now, they are around $12,000 to $13,000 and will likely be cut in half over the next few years. At the same time, ICE engine costs continue to rise. Tesla is also working to reduce charging times, currently at 20 minutes, to just 10 minutes. Elon Musk believes this is technically feasible, but he sees autonomy as Tesla's greatest competitive advantage. Incremental investments in Tesla are becoming incredibly profitable. The company is currently producing 5,000 cars per week, with plans to ramp up significantly. By 2030, Tesla could be a trillion-dollar company. The reason unions struggle to organize Tesla workers is simple. Employees are becoming wealthy shareholders. Last year, 5.8 million people applied for 30,000 job openings at Tesla and SpaceX. When people see the financial upside, there's less incentive to unionize. Tesla isn't just a car company. It's a technology company that happens to make vehicles. Unlike legacy automakers, Tesla is profitable on every vehicle it sells. Ford, for instance, loses $36,000 per electric car. Meanwhile, Tesla was making $15 billion per year on a $7 billion factory, an astonishing return on investment. Everything Tesla does is about driving down costs. Tesla's cars collect over 100 million miles of real-world driving data per day. In 18 months, Tesla will have more computational power than any company in the world. There are 1.5 billion gas-powered cars that need to be replaced, and Tesla is well-positioned to capture a major share of that market. Dealerships don't want to sell EVs because they make their money on maintenance. Since EVs require far less servicing, dealers actively discourage customers from buying them. This is one reason Tesla's direct-to-consumer model is so effective. Tesla's growth is undeniable. In 2014, they sold just 41,000 cars per year. Today, they're producing nearly 2 million annually. China accounts for about 1 million of those vehicles, many of which are exported to Europe. Tesla was the first foreign automaker allowed to operate in China without a local partner, a testament to the strength of its relationships there. Looking forward, Tesla plans to build factories worldwide to produce low-cost cars. Imagine Tesla selling a $25,000 car, which is expected to happen in the next year or two. That model alone is projected to sell 5 million units annually. Tesla isn't just an automaker, it's an ecosystem. Elon Musk has transformed multiple industries, and his compensation reflects that. When Tesla's market cap was $53 billion, he structured a pay package based on performance milestones. The company soared to over $1 trillion at its peak, and even at $550 billion today, I believe it has significant room for growth. Over the next decade, investors could see their money multiply 4 or 5 times. Many people once dismissed Tesla as a luxury brand, but today it's offering cars at competitive prices. The average car in the U.S. costs $48,000. Last year, Tesla's average price was $50,000 before incentives. This year, thanks to the $7,500 tax credit, a Model Y costs just $33,000, less than a BMW 3 Series, but with far superior technology. The Model Y is now the best-selling car in the world. Only 6% of vehicles today are electric, and EVs make up just 1% of the global fleet. There's an enormous market opportunity ahead. Tesla is solving major bottlenecks like charging infrastructure and insurance, making EV ownership even more accessible. Tesla's return on investment is remarkable. Most companies target a 15% return on capital. Tesla was generating $15 billion annually from a $7 billion factory, more than double the typical industrial return. Despite Tesla tripling in size over the past 3 years, its stock is trading at the same levels as 2021. This represents a massive opportunity. When we first invested in Tesla in 2014, revenue was under $3 billion. This year, it will exceed $27 billion, and in 2 years, it could reach $100 billion. The company is growing at an unprecedented pace, yet the stock is priced as if nothing has changed. With 90 million cars sold annually worldwide, Tesla's ability to scale production while cutting costs puts it in a league of its own. The battery revolution is only beginning. In 2010, an EV battery cost $100,000. When Tesla went public, it was around $35,000. Today, it's just over $10,000, on its way to $5,000. As battery efficiency improves and costs decline, Tesla's dominance will only grow.